Dear viewers, even as the monsoon clouds stretch longer than expected, playing spoil sport for quarterly earnings, there's a different kind of downpour drenching Dalal Street. It is raining IPOs. Lenskart, Groww, Hyundai Motor India, Aditya Infotech, Swiggy, Urban Company. Names we use every day are now making their way to Indian stock markets. And as the IPO season heats up, it's not just the institutions lining up. Young investors armed with new demat accounts and dreams of easy listing gains are diving headfirst into the frenzy, many for the first time. Social media is filled with screenshots of grey market premiums. Telegram groups are buzzing with allotment tips, and the buzzword-laden prospectuses make even loss-making firms sound like the next big thing in the AI-driven consumer tech. But take a step back. Every flood leaves behind debris. This IPO mania feels familiar. Retail investors are redeeming their FDs to chase short-term gains, while the real winners, company promoters, VCs, and private equity funds are quietly cashing out at sky-high valuations. When the cycle turns, and it always does, don't be surprised if today's market darlings start trading below their issue prices. Remember Paytm, Nykaa, Mamaearth, or Zomato's roller coaster ride? Listing day fireworks rarely last long. Take GMPs not with a pinch but with a fist of salt. Even the much hyped Tata Capital IPO saw its grey market premium shrink from over Rs 90 per share to less than Rs 10 before listing. What is fascinating and worrying about this IPO wave is the kind of companies hitting the market. Many are loss-making yet priced like global monopolies. Buzzwords like AI, machine learning, GMV, and TAM expansion are thrown around to justify valuations that even seasoned investors find hard to digest. And where does the money go? Well, not into growth or innovation, but largely into offer for sale, that is exits for promoters and early investors. For them, the IPO is not a new beginning, it is the end game. As Zerodha's Nitin Kamath put it in a Money Control interview on why they are not going for an IPO, he stated that when you take money from someone, you have an obligation. The businesses they are in does not offer predictability, and they don't want people to put their money at risk. He thinks it would be bad karma if the retail investors lose money, especially when promoters have zero sense of the future revenue and profit stream. Quite relevant when Groww, Zerodha's peer and competitor, is all set to go public with all the hype. So here is how you can play smartly the IPO game. First, separate your fun money from real investments. Treat IPO like a gambling money and itch, not a long-term wealth creator. Invest only what you can afford to lose without losing sight and derailing your financial goals. Second, check the motive. If it is majorly an offer for sale, meaning promoters offloading, it is a warning sign. Why should you buy what insiders are so desperate to sell? Third, look for skin in the game. Promoters reducing their holdings sharply post-listing is a classic warning sign. In many cases, the promoter stake has come down to below 10% and has even been reduced to nil post-listing. For them, IPO is the end game. And then watch for window dressing. A company turning profitable just before the IPO could be putting on makeup for the listing photo shoot. Look for consistent performance over several years, not just a sudden glow-up. Compare valuations. Before subscribing, ask yourself, are there better established businesses in the same sector already available at cheaper valuations? If yes, you probably already know the answer. And then ignore the smart investor hype. Even institutional investors have FOMO. Just because a big fund participated doesn't mean it's a bargain. The way even the smart investors are making a beeline for loss-making IPOs, I would ignore the factor. Warren Buffett once said, it's almost a mathematical impossibility that the most attractively priced stock is the one being sold to you by an insider. When the markets are euphoric, anything can look like genius. But when the tide goes out, only quality stands. Right now, markets are firmly rooted in the greed zone. Some of the best investments come after listing when the hype dies down and the fundamentals take over. So wait for your pitch. Hope you found this video useful. Thank you for watching. Goodbye.